Good day. Welcome to another section of AE Accounting Tutorials. We are continuing our series on partnership accounts. This time we are taking another question on admission of a new partner. But then the admission of the new partner, it is being done within the financial year. That is at the middle of the financial year. Okay, but remember that in our previous question, we looked at a question where the partner is being admitted at the beginning or at the end of the financial year. Is that okay? But this time, the partner is being admitted at the middle or within the financial year. I told you its treatment is quite tedious. We need to use the fractional policy to determine their apportion. Is that okay? This is normally examined at a higher level. So let's go through the question and solve it together. But before we go through the question, if you haven't subscribed to the channel, kindly subscribe to my channel, turn on the notification bell so that anytime I upload any new video, you will get notified, because we have so many videos or we have so many things to learn together. Thank you. So let's go through the question together. Inshira and Aduma have been in partnership for many years, sharing profits or losses equally. The partners agreed to admit Nyamiche into the firm effective 1st September 2021. The new partnership agreement provides for profits or losses be shared in a ratio 2:2:1 for Inshira, Aduma, and Nyamiche respectively. Nyamiche introduced 4,200 cash into the partnership. The goodwill figure at 31st August 2021 was agreed at 6,000 Ghana cedis. The goodwill is not to be maintained in the book of accounts. Each partner is entitled to salary of 1,200 cedis per annum. The trial balance as at 31st December 2021. We have capital account balances as at 1st January 2021. Inshira 4,500, Aduma 3,000 Ghana cedis. The current account balances as at 1st January 2021. We have Inshira 9,000, Aduma. Inshira is 900, a debit balance, and Aduma is 570 Ghana cedis credit balance. Motor vehicle at cost at 1st January 2021 is 4,800. Fixtures and fittings at cost at the beginning of the year is 1,200 Ghana cedis. Provision for depreciation 1st January 2021, we have motor vehicle 1,920 Ghana cedis. Fixtures and fittings 600 Ghana cedis. We have gross profit of 34,200 Ghana cedis. Selling and distribution expenses is 7,500 Ghana cedis. Administrative expenses 3,300 Ghana cedis. General expenses 8,250. Purchasing of business premises is 18,000 Ghana cedis. Closing inventory in trade is 3,420. We have trade debtors being 5,100. Trade creditors 9,430 Ghana cedis. Bank overdraft 4,380 Ghana cedis. Drawings: Inshira 2,130 Ghana cedis. Aduma 2,400 Ghana cedis. Nyamiche 1,600 Ghana cedis. The total of the trial balance is 58,600, both debit and credit. On 1st July 2021, the partners purchased a new business premises. The estimated useful life of the building was 25 years at the date of acquisition. Motor vehicle and fixtures and fittings are depreciated at a rate of 20% and 10% per annum, respectively on costs. Assume that revenue and expenditure accrued evenly distributed. Assume that revenue and expenditure accrued evenly throughout the year. You are required to prepare A, the profit or loss account for the year ended 31st December 2021. B, profit or loss operation account for the year ended 31st December 2021. And C, statement of financial position of the firm as at 31st December 2021. Is that okay? So here, the partner is being admitted on 1st September 2021. Unlike our previous question where they admit partners at the end or at the beginning of the year, where they will give us the initial statement of financial position just before admission or just after admission, so that they will give us the terms and conditions to apply to prepare the final statement of financial position. It's not like that. But this time, we have been given the statement of financial position where the partner is being admitted within the financial year. So we have to use the fractional policy to determine their apportions. The first requirement is to prepare the profit or loss account for the year ended 31st December 2021. So let's look at how we are going to go by it. But let me give you a clue. One, goodwill is not to be maintained in the book. So we have to know how to treat that. We'll be looking at it. And then on 1st January 2021, the partners purchased a business premises. Is that okay? So business premises costing 18,000 has been purchased on 1st July 2021. So it means this asset is not in the business for the whole year. Is that okay? So you have to, when we are determining depreciation, you have to consider the number of months the asset is in the business. So let's begin. So Inshira and Duma and Nyamichi. Now we are going to prepare the profit or loss account. So we have profit or loss account. For the year ending 31st December 2021. Okay. We can realize that I told you the partner is admitted on 1st September 2021. So in preparing our accounts, we have to prepare for before admission and after admission. Is that okay? Even if it is profit we wanted to determine, we have to calculate for before admission and after admission. So that will be pre-admission. So we have the pre-admission. And post-admission. And we consider the total for the year. So before admission, that was 1st January, that is 1st January 2021 to 31st of August 2021. That is before admission. And after admission, that is 1st of September 2021 to 31st of December 2021. That is after admission. Okay. Now, they say we should prepare the profit or loss account. But remember that we have been given the gross profit. So straight away, we'll be given the gross profit. So from the question, the gross profit in the question is 34,200. So the total gross profit is 34,200. So we are going to use the fractional policy to determine profits before admission and after admission. So from January to August, August is 8 months. So it will be in the ratio of 8:4. So that it will be for the whole of the 12 months. Is that okay? So for this, we have 8 out of 12 multiplied by the profit. That is before admission. Is that okay? And when we do that, it is going to give us 22. That is profit. 22,800. Is that okay? Good. And we are going to do same for post-admission. That will be 4 out of 12 multiplied by 34,200. That is the total gross profit. And that is going to give us 11,400. So that the 2 will give us the total gross profit. Is that clear? So we are going to adopt the fractional policy in determining the expenses as well. So the next expenses you can see from here is the selling and distribution expenses. Okay, so we have selling and distribution expenses, and it was from the question is 7,500. So we apply the same fractional policy. We have 5,000 and 2,500. That is from the period of January to August ending. Okay, that is 8 over 12 times the total will give us this, and the 4 over 12 times the total will give us this. Okay, after that, the next expenses is administrative expenses. So administrative expenses, and the total is 33,000. So the total is 33,000 or 3,300. Good, 3,300. So we are going to share based on the fraction, that is, or the ratio, that is 1,100. And this is going to give us 2,200 rather. Good. We are using the fractional policy. So here, 8 over 12 times the total profit will give us for the pre-admission. Good. The next expenses is general expenses, okay? And the general expenses is 8,250. So general expenses is 8,250. Is that okay? So we are going to apply 8 over 12 times the total general expenses, and that is going to give us 5,000. And for this, it is going to give us 2,750. That is 4 out of 12 times the total general expenses. Good. So the next expenses we talk about is the depreciation. Okay. So let's consider the depreciation. With the depreciation, we have business premises. But remember that the business premises was acquired, or we purchased the business premises on 1st July 2021. Is that okay? So it means that this asset is only in the business for the last 6 months of the year. That is from July to December. Is that okay? So it means that before admission, it was used for only 2 months. And after that, the remaining 4 months, that is from September to December, is for post-admission. Is that okay? So let's consider that. And the cost of the asset, that is the business premises, is 18,000. Is that clear? And the useful life of this asset, that is the business premises, is 25 years. So to get the depreciation, this is what we are going to do. 720. Okay, 720 as the annual depreciation. Remember that it was in the business for only 6 months. So multiply by the 6 out of 12. And that is going to give us 360. Okay, so the depreciation for the last 6 months is 360. And remember that for pre-admission, it was in the business for only 2 months. So 2 out of the 6, the total ratio, multiplied by the 360, it is going to give us 120. And 4 out of that is post-admission, be 4 out of 6. So 4 out of 6 times is going to give us 240 as well. Good. So we are done with the business premises depreciation for the year because it was in the business for only 6 months. So we have another depreciation, that is furniture and fittings. Furniture and fittings. Or fixtures rather. Fixtures and fittings. For the fixtures and fittings, the cost was 1,200. Good. And we are to apply depreciation on furniture and fittings 10%. Okay. So for 10%, that is 10% on the cost of 1,200 is going to give us 120. So the total depreciation for the year is 120. This fixtures and fittings is in the year for it is in the business for the whole year. That is the whole 12 months. Is that okay? So for before admission, it is 8 months. So we use this as 2 out of this way. This is the ratio. But this is 8 of 4. So the first one is going to get 80. The second one is going to get 40. Good. That is post admission. The next asset is motor vehicle. Motor vehicle. The cost of the motor vehicle in the question is 4,800, and it was also in the business for the full 12 months. Okay, we are to apply 20% on the 4,800. That is going to give us 960. Is that okay? This is going to give us 960. So we are going to use the same 8 of 4 to determine the depreciation, okay, for pre-admission and post-admission. This is before admission and after admission, so the total is 960. So this will be 640 and this will be 320. Good. I hope you are getting the concepts. Okay. So we are done with the depreciation. So I think this is all of the expenses from the question. So we can add the total expenses and take it from the gross profit to arrive at our net profit. So this total expenses, it is going to give us 13,540. Okay. And we are going to take this from the total gross profit. Okay. And it is going to give us 9,260. You do see the total of this. When we sum this total expenses, I think we'll be getting 6,950 as the total expenses. Then we subtract it from the gross profits. The gross profit is 11,400, and this is going to give us 4,450. All right. So the total expenses over here, when we add this, I think we'll be getting 20,000. That is 290. 20,290. Good. Then we take it from the gross profits, and this is going to give us 13,710. So this is now the total expenses, and this is the net profit. The net profit brought down. Is that okay? This is the net profit brought down. So we are done with the requirement A. That is, we should prepare the profit or loss account. Is that okay? So after preparing the profit or loss account, the next requirement is to prepare the profit or loss appropriation account for the year ended 31st December 2021. So we begin the profit and loss appropriation account with the net profit we ascertain from the profit or loss account. I want you to understand that the profit or loss appropriation account, it is used to share the profits ascertained from the profit or loss account to the partners. Is that okay? But before we share the profits, there are certain adjustments that will be made on the profits. So if there is any entitlement, if there is any charges against partner, we are going to add it to the gross profits. So all entitlement to partners, we also less it from the gross profits before we share. Okay, so when we do that, we are going to arrive at our residual profits, then we share it among the partners. So let's see how we prepare the profit or loss appropriation account as well. We are going to begin with this. We are going to begin with the net profit. Bear in mind, so I'm going to clean the board. So the requirement B is saying that we should prepare the profit or loss appropriation account for the year ended 31st December 2021. And we are presenting it before admission and after admission, that is pre-admission and post-admission. But remember that I told you we are preparing this account to share the profits or loss ascertained from the profit or loss account. And from the profit or loss account, we had a net profit. Because we are using it to share the net profit, we will begin with the net profit. Is that okay? So we had a net profit of 9,260. We have 4,450, 13,710. Good. So we are going to share this profit, but before we share, we are going to make some adjustments. So let's check from the question, is there any charges against partners? So from the question, there is no charges against partners. If there is any charges against partners, we should have added to the net profit. But because there is no charges, we subtract all entitlements to partners. Is that okay? So with an entitlement to partners from the question, it says that each partner is entitled to a salary of 1,200 Ghana cedis per annum. Every year, each partner will receive a salary of 1,200, and we are going to pay it out of our net profits. So straight away, we are going to less deductions. So less deductions. Oh yes, less deduction. So with the deductions, I think we have only one. Okay, that is the salaries. So partner salaries. That is 1,200 each partner. Okay, we have 3 partners. That is we have Inshira, we have Adoma, and we have Namiche. Each person is going to receive 1,200. So Inshira will be receiving 1,200 per annum as his total. Because he is in the business for the whole year, he will receive the full salary. Adoma to the same thing. But remember that for Namiche, we admit him in effective 1st September 2021. So he's in the business for only 4 months, from September to December. So the 4 out of the 12 months of the annual salary, he is going to receive 400. Good. So it means that he is going to receive 400 as his annual depreciation as his annual salary, because he's in the business for only 4 months. Is that okay? So we are going to, after admission, he had 400. Before admission or pre-admission, Namiche wasn't in the business, so nothing for him. So we are going to adopt these 2 people are in the business for the whole year. We are still going to adopt the 8 out of 4. Because pre-admission is 8 months, after admission is 4 months. So that's going to give us 800 against 400. The same 800 against 400. So we are done with the deductions. So we have to share the profit. Before we share, let's less the deduction from the net profit. So by lesson, we add these 2, we less it from this. And that is going to give us 7,660. We less this 30 from this, it is going to give us 30,250. Less this 30 from this, it is going to give us 10,910. Okay, and this becomes the residual profit. We are going to share the residual profit among them. Is that okay? By sharing the residual profits, we share the profit based on the profit or loss sharing ratio. So we have 3 partners. So share of profit. Share of profit we have, that is Inshira Adoma. We have Namiche. Good. We are going to share the residual profit under pre-admission for only two partners, that is Nhyira and Adoma, because before admission, Nyamiche wasn't in the partnership firm, so he's not going to enjoy before, that is pre-admission stage. He's not going to enjoy. So when we divide this by two, initially they were equal partners. Is that clear? They are going to get 3,830 each. 3,830 each. Pre-admission, Nyamiche is not going to get, but post-admission, Nyamiche was there. So we are going to apply the profit or loss sharing ratio, which is 2:2:1. So for the first person, we receive 2 out of 5 multiplied by the residual profit, and that is going to give him 1,300. The second person 1,300, also 2, but this one 1 out of 5 is going to give him 650. Good. So after that, then we add the 2. We are going to add the 2 to get the total share of profit. Is that okay? That is going to give us 51,000, 5,130, 5,000. We add this to 5,130, and this will be 650. I think this is clear. So when we add this, it should give us the residual profit back. Is that clear? So the residual profit 92.6. Yes, good. So 44.50, and this is 13,710. That is where we add this back. Okay, it's supposed to give us this. Is that clear? Good. That is where we take this from this. Nothing is left. It has been shared off. So when we take this from the net profit, nothing will be left because it has been shared among the partners. So remember that now we are done with the requirement 2. Now we are going to prepare the statement of financial position of the firm as at 31st December 2021. But remember that for the preparation of the statement of financial position, because the partners are 3, we are going to have different capital account balances, okay, and current account balances. And before we prepare the statement of financial position, let's first of all prepare the individual partners' capital accounts and current accounts. Is that okay? So this share of profit is going to be credited to the partners' current account because it is an income to them. So the corresponding entry will go to the credit side of the partners' current account. Is that okay? So let's first of all consider the partners' capital account. So let's begin with the preparation of the partners' capital account and the current account as well. But this is not part of the requirement. It is just workings to help you prepare the statement of financial position. So there was a balance brought down for the partners from the question. For Nhyira, it was 4,500 and Adoma 3,000 in the previous balance sheet. So 4,500 and 3,000 for Adoma. So Nhyira, Adoma, and Nyamiche. Nyamiche wasn't there initially. Okay. And when we admit Nyamiche introduced capital in the form of cash. And the value is 4,200. That is, he introduced 4,200. But remember that there was a goodwill in the question. And the question says the goodwill should be written off, or the goodwill should not be maintained in the book. So let's see something from this angle. We have goodwill account. With a goodwill account, goodwill is an asset, so we are going to debit. The value of the goodwill is 6,000. It has been valued for us, internally valued. So it will go to the capital account as the corresponding entry. So we are going to debit goodwill because it is an asset, intangible asset for the first 2 partners initially. So we have Nhyira and we have Nhyira and we have Adoma. So they were equal partners initially. It was 6,000, so each person is going to get 3,000 this way. So the total is going to be 6,000 as the value of goodwill, 6,000 as the value of goodwill. Because we are not going to maintain in the group. Because we are not going to maintain the goodwill in our book, we are going to write it off by crediting the goodwill account with the new profit and loss sharing ratio among the partners. So we have Inshira, Adoma, and Nyamiche. Is that okay? The new profit and loss sharing ratio is 2:2:1. So Inshira will get 2,400, 2,400, and 1,200. For Nyamiche, that is 1/5 times the 6,000. So it means goodwill is not going to be maintained. Okay, so from this goodwill account, we are going to transfer this amount from the debit side of goodwill to the credit side of the partner's capital account. So goodwill, this goodwill introduced by the two partners. Okay, 3,000, 3,000. Nyamiche wasn't there by then. So you are going to transfer this credit entry, the written off, from the credit side of goodwill account to the debit side of goodwill account. So this is goodwill written off. Okay, the first person is 2,400, second 2,400, and the third is 1,200. Good, so we are done with all entries that's supposed to go to the capital account. So we have to close this account. By closing the account, obviously the credit side is bigger. So we are going to close the account. So here will be 4,200. This is going to give us 6,000. And this is going to give us 7,500. The same here, 4,200. We are going to have 6,000. And we are going to have 7,500. So the balance carried down. The balance carried down is going to be 5,100. And this is going to give us 3,600. And this is going to give us 3,000. Good. And this will be the balance brought down, So the brought down will be the carry down here. 5,100, 3,600, and 3,000. So remember that when we are preparing our final statement of financial position, we are going to present these items or this amount as their capital account balances under finance bank. So we are also going to look at the current accounts of the partners as well. So put these figures in your mind, we are going to use them. So let's look at the current account of the partners as well. Okay, so with the partners' current account, let's consider their initial balances. Is that okay? So from the question, Adoma was having a credit balance of 570. Okay, but as for Inshira, he was having a debit balance of 900. Is that okay? Good. From the initial balance sheets. So yes, from the initial trial balance rather. From the initial trial balance, good. So after that, we consider their salaries. The salary that has been given to them, or their entitlement and salary, will be credited to their current account. So we have salaries. Each partner receives 1,200. 1,200. But remember that Inshira was in the business for only 4 months, so he received 400 when we were doing the operation. Is that okay? And you can remember that from the profit or loss of operation account, we also share profit. Okay, so share of profit. So with the share of profit, Inshira had 5,130. The same to Adoma, 5,130. But as for Nyamiche, he received 630 because of the profit and loss sharing ratio. We use the profit and loss sharing ratio to share the profit to them. Good. So after that, we consider drawings. From the question, they made drawings as well. That is Nhyira, Adoma, and Nyamiche, all of them. Okay. And Nhyira made drawings of, so that is drawings. Because the drawings is going to reduce their capital account. When you withdraw money, it is going to reduce your current account. So we are going to debit it to reduce their account balance, because the current account increases when we credit it, and it decreases when we debit it as well. So Nhyira had made withdrawal of 21,300. Adoma made 2,400. And from the question, Nyamiche also made drawings of 1,600. Good. So these are all of the entries to this account. So we have to close this account. So by closing this account, so we are going to close the account. The credit side is bigger. Is that okay? And that is 6,330. When we add this 6,330, it means here to be 6,330. So when we add this, it is going to give us 6,900. So the debit side to 6,900. When we consider this is lesser as compared to this, so it will be 1,600. 1,600. Okay, so let's consider the carrying amount or the balance CD. With the balance CD, this place is the smallest. I guess so. So that is 3,300. This is smallest. So when we take it from this, we are going to arrive at 4,500. But here, this is bigger than this. So when we strike this from this, we need to add 550 over here. That is another balance carry down. So carry downs are 2. So when we come here, we get brought down as 550. This will come here as another brought down, being 3,300 plus 4,500. Good. And this, there is nothing. So nothing. Good. It means that for Adoma and Nhyira, their current account balances has a credit balance, that is a positive. Whereas for Nhyira, he had a negative or a debit current account balance, that is a negative. Good. So we are going to transfer these balances to the statement of financial position under the finance part. So let's see how the statement of financial position will also look like. Good. So we are going to prepare the statement of financial position, that is requirement C. So we begin with the non-current asset. Is that okay? So we have business premises. So business premises. The cost from the trial balance is 18,000. Is that okay? And it was in the business for only 6 months. So each annual depreciation we calculated from our previous workings was 360. Is that okay? So when we let's calculate depreciation from the cost, we are going to get 17,640. Good. So we consider the next asset, that is fixtures and fittings. Good. The cost is 1,200 Ghana cedis, and its annual depreciation, the one we calculated was 100, that's 120. Okay, the annual depreciation we calculated was 120, and there was an accumulated depreciation of 600. That is from the trial balance. When we add the two, we are going to get 720. So when we less the accumulated depreciation from the cost, we are going to get 480 as the net book value. Good. So the next is motor vehicle. With the motor vehicle, the cost from the question is 4,800. That is 4,800 from the trial balance. But remember that there was an accumulated depreciation from the trial balance. That's 19,200 from the trial balance. Yes, that is 1,920. 1,920. And when we calculated the annual depreciation, we had 960. From our workings, we had 960. So when we add the two, we are going to get an accumulated depreciation of 2,280. So we are going to subtract this from this, and that is going to give us 1,920. Good. 1,920. So we are going to sum them up. So when we add the cost, we are going to get 24,000. When we add the accumulated depreciation, we are going to get 3,960. And then the net book value is going to give us 20,040. Good. So let's consider the current asset. With the current asset, we have inventory. With the inventory from our trial balance, it was 3,420. So it was 3,420. And we had a debtors balance. The debtors from the trial balance is also 5,100. That is from the question. Okay, 5,100. Then we are going to add the two, making 8,520. Good. Let's consider let's less our current liabilities or liability. Good. With the current liability, we have creditors. From the trial balance, okay, it was 9,430. So 9,430 from the question. Good. And we have cash. Is that okay? There was an introduction of cash and there was bank overdraft. Okay. There was an introduction of cash by the new partner. So let's do set off and get the balance. So let's see if the bank account initially there was bank overdraft, so that is the balance brought down was 4,380, and there was an introduction of cash. Is that okay? That is cash, and the amount was 4,200 by Nyamiche. Good. So when we want to balance off this account, we are going to have the current amount in, because the total will be 4,380. So the current amount will be 180, which will still be a credit balance of 180 as bank overdraft. So we are not going to present the cash, we are doing set off to, so this will be the bank overdraft balance or remaining. So this is all of the creditors. Good. Sorry, this is the current liability column. We have creditors being 9,430. Good. So now let's consider the bank overdraft, because we didn't record the cash over here. We did set off so that the remaining bank overdraft will be recorded. So bank overdraft. It was 180. The balance over the 180. Okay. So when we add these two, it is going to give us 9,610. So 9,610. So we are going to take this from the current assets. So when we less this from this, it's going to give us 18,950 as the net asset of the business. Good. 18,950. So let's consider the finance by column over here. So finance by. So we have capital. The partners are three. We have Nhyira, we have Adoma, and we have Nyamekye. Okay, so from their capital account balances we had, from the capital accounts of the partners we prepared, Nhyira happens to get an amount of 5,100. If you can remember, 5,100. And Adoma had 3,600. And Nyamekye also had 3,000 as their capital account balances. So we add the three. And this is going to give us 11,700. Good. Let's consider that their current account balance. Okay. So current account balance. Okay. We also have three. We have three partners. That is Nhyira, Adoma, and Nyamekye. So if you can remember their current account balances, Nhyira happened to get an amount of 3,300 as his current account balance, and Adoma had 4,500. But unfortunately, Nyamekye had a debit balance. Okay, that is a negative balance of 550, if you can remember. So a negative balance will be in brackets. So we add these three, it is going to give us 7,250. So when we add the current account balance to the capital account balance, we are going to get 18,950 as the capital employed by the partners in the business. So you can see that the net asset of the business is the same as the capital employed of the business. So basically, this is how we account for an admission of a new partner. That is where the partner is being admitted in the middle or within the financial year. Is that okay? This is normally examined at the higher level of the education. Is that okay? So in our next video, we'll be looking at a retirement or death or withdrawal of a partner. So when a partner dies or when a partner withdraw or retire from the business, how are we going to make its accounting arrangement? Okay, so just subscribe to the channel, turn on the notification bell so that anytime I upload video on that, you will get notified on your devices. Until we meet in our next video, I think bye for now.